India Limited Q2 and H1 FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. From the management, today we have on the call Mr. Chetan Shah, Managing Director, Mr. Masanori Ozawa, Non-Executive Director, Mr. Sushil Marfatia, Executive Director, Dr. Suresh Ramachandran, Whole-Time Director and Chief Commercial Officer, Mr. Kunal Mittal, Senior Vice President, Planning and Coordination Office, Mr. Anil Nawal, Chief Financial Officer, Mrs. Deepika Trivedi, Company Secretary and Compliance Officer, and colleagues from SGA, their Investor Relations Advisors. Managing Director of Sumitomo Chemical India Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, a very good afternoon to all of you, and welcome to the conference call to discuss the Q2 financial year 23-24 performance of our company, SCIL. Since end of the year 22, the agrochemical sector is navigating through a challenging phase characterized by an elevated build-up of inventory throughout various distribution channels and reduction in demand due to erratic weather conditions and reduction in prices. The domestic agrochemical industry was unable to maintain the demand momentum it typically exhibits during the second quarter. This can be attributed primarily to dynamic and varying weather patterns that were prevalent across the country. The untimely arrival of the monsoon towards the conclusion of June and unfavorable disrupted the customary agriculture timetable, consequently resulting into postponement of crop planting. Subsequently, the dry spell experienced in August and the adverse effect on crop yields, resulting in reduction of both pest and fungal infestations. Therefore, there has been a noticeable decrease in the pesticide applications and consumption. If you recall, the monsoon did not start in June at all, and we got some showers at the fag end of the month of June. July, it picked up, and everyone, including us, were hopeful that the season will go okay. However, we experienced an unbelievable dry spell in the month of August, which ruined the entire planning and entire, agrochemical consumption. Coupled with erratic monsoons, the El Nino contributed conditions led to long dry spells and distribution of rainfall, which in turn impacted an overall volume sales growth of agrochemical in domestic market. The agrochemical industry also experienced pricing pressure in case of generics as a result of declining prices in China, which happens to be the largest supplier of raw materials. Due to unstable inflationary environment, unfavorable weather condition, and channel inventory pile-up in Latin America and across the globe, oversupply situation caused by China, the global crop protection chemical market also experienced a spell of uncertainty. Supply uncertainties in last 2 years and increased supplies of low-priced products from China led to global agrochemical companies and channel partners increasing inventory levels. The subsequent restocking amid the slowing global economy led up to slump in exports from Indian agrochemical companies in the first half of the financial year. On a brighter side, I would like to say that our company was able to consume all the high-cost inventory that we were carrying as of 31st March 2023 by the month of July. And we are back to our normal profits or normal profit lines or normal bottom line from the month of August. This is a satisfactory situation for us, and going forward, we feel strongly that we'll keep up the momentum to maintain our profit margins. Specialty products portfolio of our company were less impacted by price variations, and in spite of almost 15-20% price drops across the board, we could manage to drive our specialty product portfolio at only 3% lower prices as compared to the financial year 22-23. We perceive that this short-term challenging situation as a brief interval that shall allow us to introspect on our strengths and business fundamentals. Guided by our strategic theme of back to core, that is back to going to the fields of the farmers and meeting the farmers, while we continue to take best efforts to minimize adverse impact of this current short-term challenging situation, we are also working on various growth strategies for medium to long term, including expansion of product portfolio for distribution as well as manufacturing at our manufacturing sites. I firmly believe that our fundamentals are strong. They will remain strong, and we will certainly bounce back in a normal year of 24-25. With this, I'll now hand over the call to Mr. Anil Nawal, our CFO, to run through Q2 financial year 24 consolidated financial performance. Thank you so much.
Consolidated Q2 FY23-24 financial performance. We recorded revenue of rupees 903 crore in Q2 FY24 as compared to rupees 1121 crore rupees in Q2 FY23. Gross margin in Q2 FY23-24 are 38.4% as compared to 31.1% in Q1 FY23-24. This is showing sequential improvement and recovery. EBITDA came at rupees 188 crore in Q2 FY24 as compared to rupees 278 crore in the same period last year. EBITDA margin in the current quarter stood at 20.8% as compared to 24.8% in Q2 FY23. The reduction in EBITDA margin was primarily on account of decline in operating leverage. Profit after tax stood at rupees 143 crore in Q2 FY24 as compared to rupees 201 crore in the same quarter last year. Profit after tax margin stood at 15.9%, whereas 18% in Q2 FY23. Throughout the period, our operations team demonstrated a steadfast commitment to strategic cost optimization initiative in light of prevailing tricky industry circumstances. Now coming to our consolidated performance for H1 FY23-24. Revenue from operations in H1 FY24 stood at rupees 1628 crore as compared to rupees 2106 crore in H1 FY23. In H1 FY24, domestic agrochemical revenue contributed about 89% of overall revenues, with export contributing the rest. In H1 FY24, insecticides contributed about 40% of total revenue, while herbicide, plant growth regulator and fungicide contributed about 29%, 10% and 7% of total revenue respectively. The proportion of export earnings as a percent of the total revenue has experienced a notable decrease, dropping from approximately 19% in H1 FY23 to around 11% in H1 FY24. The export endured headwinds as a result of elevated inventory levels, destocking by global manufacturers and significant price pressures. EBITDA stood at rupees 269 crore in H1 FY24 compared to rupees 466 crore in H1 FY23. Our EBITDA margin stood at 16.5% in H1 FY24 as compared to 22.1% in the same period last year. The profit after tax for the H1 FY24 amounted to rupees 205 crore, reflecting a decrease from the previous year's figure of rupees 340 crore as a result of dynamic and complex market conditions. Now with that, I will now hand over the call to Mr. Sushil.
Good afternoon, everyone. In continuation of Mr. Naval, I state that we maintained the significant lower inventory level as compared to previous quarters in view of challenging situation in the market in short term. In terms of overall net working capital cycle, it stood at 70 days, recording a deduction of 24 days as on September 23 as compared to that of June 23 as well as compared to September 22. During H1 24, our collections were 2,000 crores against sales of 1,628 crores during H1 2024. Such a good level of collection demonstrates company's strong focus on discipline even in such a challenging environment. This also indicates our team's ability to generate ground level demand and liquidation followed by actual collections. No sales in our sector should be considered final till the material is consumed and collections are realized. And our team continue to keep this in mind and follow disciplined practices irrespective of these circumstances. Our projects team expanded our manufacturing capacities in line with the Make in India initiative. In FY21, we had announced plans to invest 1.2 million in two Make in India initiative to develop 5 proprietary products for our parent company SSE Japan and our global affiliates. This represented supplementary capital expenditure beyond our customary allocation for maintenance and capacity improvements in our current product line. The first project at Bhavnagar facility has commenced production for a global proprietary product. The second project at Tarapur facility involving multiple EHD products has started commercial production recently. Both these projects are expected to generate some revenue in current fiscal year FY23-24. However, due to destocking in international markets, major ramp up in the revenue from this product is expected from FY24-25. The aforementioned projects are being implemented in our current facilities and the expected operating margins are in line with SCIL's current margin for similar products. The management team is actively exploring the potential for diversification by considering a range of additional products offering that could be produced within the Indian market. These opportunities are currently undergoing thorough evaluation and are subject to ongoing discussions at different stages of decision-making process. Following the endorsement of the project and products by the Board of Directors, we will provide you with comprehensive information pertaining to our capital expenditure strategies. Our R&D team is presently engaged in production of diverse range of products and pre-mixture combination products with the aim of catering to both the Indian domestic market and lucrative export market. These export markets situated in high growth regions like Latin America, Africa and the Asia Pacific region hold immense potential for our organization. We would like to second what Sasan mentioned. We are proud of all our teams who work together In this challenging situation, as one of the most diversified platform in Indian agrochemical sector, we continue on the path towards our strategic ambition of taking leadership position in Indian agrochemical market. I now request my colleague Dr. Suresh Ramchandran to give more information on our business and strategies.
Thank you, Mr. Mulfatia. Good afternoon, everyone. Talking about the business, the overall unfavorable domestic conditions, as explained by Shasan, in domestic as well as export markets, have led to negative impact on demand as well as consumption during the quarter that just ended. We believe our quarterly performance is reflective of the challenging environment the industry is currently facing. High channel inventory at the beginning of the year, slowly coming down, elevated cost, coupled with negative sentiments apart from erratic weather patterns, really put a negative sentiment at the trade channel level that has impacted our sales. We also faced pricing pressure in case of generic due to falling prices. Revenue decline owing to subdued performance of our export business, which witnessed a significant year-on-year decline compared to previous year same quarter. Domestic business performed relatively better with a degrowth of just about 10% in quarter 2 that just concluded compared to the corresponding quarter of last year. Product in specialty segment also faced relatively little bit higher degrowth as compared to those in generic segment because of the overall reduced consumption of agrochemicals in quarter 2. Long dry spells in key regions of India had adverse effect on the impact on the sales of our products. Given the aforementioned background, it is evident that our year-over-year revenue as well as EBITDA growth experienced a subdued quarter, primarily due to the challenges faced in terms of both top-line performance and margins. However, we focused on reducing overall overhead costs. The ongoing pressure on pricing as well as the continuing stock overhang is expected to persist, albeit with a potentially less severe impact. Demand momentum both in India and abroad, weather conditions in the key export markets and prices of key products and raw materials, especially Chinese, will be the key factors to watch out for in the coming quarters. In domestic business, we launched 3 herbicides, 1 insecticide and 2 fungicides in the first half of this financial year. We are receiving positive feedback from the trade and farmers on our recently launched products like Corco, Ambit, Deraco, Q-Flow, Rumpus, etc. Our focus will remain to ramp up the sales of our new products in the coming quarters. Our new products have been successfully launched to our channel partners and farmers through both physical and digital meetings. Our company's robust field promotion initiatives have enabled us to establish direct connection with the farmers, thereby facilitating their access to optimal farm management techniques. This in turn empowers them to enhance productivity and operate more efficient agribusiness. By leveraging real-time feedback, we have the opportunity to enhance our relationship with farmers, gain valuable insights into their needs and drive growth as an organization. We have directly reached out to approximately 4.4 plus million farmers and 40,000 dealers. We are also gearing up to launch a few more new products in the near future, which are expected to ramp up over the next few years. Our portfolio comprises of 200 plus agrochemical brands across the entire value chain, including 20 plus mega brands with strong brand recall. Our distribution network comprises of 15,000 direct distributors and 60 depots across the country, making it one of the most extensive distribution networks in the country. Going forward, we plan to optimize the utilization of our marketing and selling tools to enhance our trade partners' engagement. Our key focus is on driving volume growth by implementing ground-level demand generation strategies for our products. We especially intend to adopt a more proactive approach on our interactions with top distributors, aiming to strengthen relationships and enhance collaboration. Additionally, a vigilant focus will be maintained on monitoring the performance of the most significant product offerings. We'll take a pause now from our side and request moderator to open the floor for questions one by one.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj K from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations for a decent performance in such a challenging environment. I just had a couple of questions and more from a historical annual perspective, just to get a better hand on the business. First is on the overall business first. So if you look at our overall sales performance, say between 2019 and 2023, the sales growth has been roughly around 13-14%. So if one were to kind of just understand better in terms of, say, the price volume trend, especially in the domestic piece, how would that have been for us? And a related question is, if I look at last 3-4 years, we have launched more than 25-30 new products, and if I look at the share of specialty or the 9(3) in these have been quite high, and in categories like PGR, fungicides, herbicides, which the high margin, high growth, which we talk about. But when you look at the revenue contribution from these segments or the absolute growth also, these are not really scaled up as per what we were thinking it to be, despite the investments in sales, marketing, digital, which we talk about. So what has been the limitations in terms of scale up? Is it more due to the pricing discipline or the tight credit terms which we always had in the market that is leading to an impact in terms of scale up to the potential? Anything you can give a color on? Thank you.
Thank you very much for your question. See, basically, whatever products we have introduced are very, very good products and very, very prospective products. Whatever we have not been able to do justice to these products, I mean, I don't want to be repetitive to say and blame everything on the weather condition or the market conditions in this year, but it is a slight awkward comparison of any of the successes of these products to the current year. If you ask me, we are very, very confident about these products. And I mean, just to give you an example, we had recently a meeting down south, and the feedback that we received from the distributors and the farmers was overwhelming on this new introduction. They say that these products are absolutely fantastic, and it can become a very, very, very big product in terms of volumes, which was a very encouraging thing for us to learn. As I said, we have not been able to do justice to this product because of the overall conditions. I think the volumes have dropped almost. Volumes and value both have dropped during the current H1. I think that the value would have dropped anywhere between product to product on 12 to 20%. And as I said, that our specialty product portfolio, the value has dropped only by 3%. However, the volumes have dropped in domestic market to around 10 to 11% combined in between specialty and generic products. Having said that, we have our main brand of glyphosate, which is Glycel. Volume of that product has increased during the year by 5%. However, the prices of glyphosate dropped 23% from the previous year's level. So there has been a lot of permutation and combination between the products, some products going up, some products going down, some products going down drastically. So it has been a very, very, sort of a mixed basket for us to handle this year in these challenging times. But the bottom line is that we are confident about our product portfolio, especially the ones which we have introduced currently. And to add, I mean, if we see the overall percentage of our fungicides or herbicides or insecticides or bio products, we have maintained the same percentage of all these segments in the current year. So it is not that one segment has gone up and another segment has come down drastically. I mean, overall in a balanced position, our entire product portfolio has remained in terms of percentage unchanged. That should give a very good confidence to us and as well to the market.
The question was largely in terms of performance between 2019 and 2023, because I understand current year is there are not many external factors which is way beyond our or anyone's control. So just to kind of dwell a little bit on this, we always talked about mega brands of say 20 plus, and so to give a perspective, if you can, on the new product, how many of the current mega brands we have are, so what is the share of new products in these mega brands, say versus 2019? And when we say a mega brand, typically is it more than 100 crore or 50 crore? So what's typically our definition of mega brand? So that is one, yeah.
First, coming to new launches, if you look at all the new products that we have launched, maybe 7 or 8 we would have launched in the last 12, 14 months. Between 2019 and 2022, let's say January, February, there were not many introductions, except all the registrations and launches happened in the last 12 to 18 months or 14 months. However, these new brands got into a situation where right from last Rabi season, right, last September timeframe onwards, the season and weather has not been supporting. And that's the reflection why these new products have not been really picked up. Especially this year, we were hoping better performance, but unfortunately, the overall consumption itself has come down, and that's the reason. But our focus continues to be on new product ramp up and ensure that the farmers get the best out of these kind of new products. In terms of mega brands, yes, we do have mega brands like Lano or Danitol, of course, glyphosate, Glycel, Mera 71, all these products. Anything that ranges above 50-60 crores, we call it as a mega brand.
Okay, and just one last question, if I can. On the margins front, if I look at a 5-year history, we have seen a significant improvement in our operating margins, and that slightly led to the benefits at the operating cost level. So in the past, we used to talk about benefits in terms of merger synergies or operating leverage or cost efficiency. What will be the major factor driving this improvement for us? If you can probably quantify or give some more detailed color in terms of the improvement in margin and sustainability.
Yeah. So see, I think overall, if you look at the last 4 or 5 years history, our margins before integration of two entities, if you see both of these entities were earning about 12 to 13% EBITDA level margin. And in both the entities, the fixed cost, if you look at it, it was about 19-20%. When we integrated the entities, started the process in 2017-18 and completed in 2019-20. So over that 2-3 year period and the 2-3 year after that, we have been able to maintain our fixed cost, which has come down to about 19-20% of revenue to about 12-13% of revenue. So that has added to the profitability. In addition to this, all our specialty segments, the product portfolio, even in the off-patent segment, the focus on the premium branded business instead of the low end of the generics and the off-patent products, we have been able to even improve our gross margins. So combined, I think over last 4 or 5 years, we have been able to improve our margin profile at EBITDA level from 13% to about 19-20%. We continue to be confident about this kind of profitability levels in the medium to long term. But in the current year, because of challenging environment and situation, we have taken a little bit of a hit. And as our CFO, Mr. Anil Naval, also mentioned, I think in the Q1, we had a kind of a very low margin at a gross profit level. But if you look at the Q2, our margins at the gross profit level is much better as compared to Q1. It is still not at the historical levels of last year, but I think on a sequential basis, we have made improvement in the margins in last few months.
Also, as I mentioned in my opening remark, we have exhausted our high cost inventories altogether, and now the prices of inputs have stabilized over a period of time, last couple of months, and we see that these prices will remain stable till the month of January. On the other side, the prices of the finished products, which dropped drastically during the year, has also stabilized. So we are very confident that we'll be able to not only maintain our margin, but maybe we can even improve a little bit.
Sure, I'll come back in here. Thank you.
Okay.
Thank you. The next question is from the line of Swati Hiru from Ratnabali Investment. Please go ahead.
Hello, thanks for this opportunity. So my first question is that we've recently made this acquisition of a company like Barrix. I just wanted to understand that given our scale and size and given how much our parent company spends on R&D in a year, what need or requirement did we have for a company this size? What are they doing that is so innovative, and how do we plan to scale that up?
Okay, so you're right. This is a small company, and that is why the acquisition cost is also smaller. We found this company very interesting from 2 points of view. One is the green technology, and second is their capability of R&D in this segment, in this, what they are making and what product lines they have got in the pipeline, and what can be done with these products, not only in Indian market, but even in the global market. So it was a very interesting opportunity for us to get into it. Yes, in terms of revenue or in terms of bottom line, it may not be so exciting for our size of company, but I think it was important for us to get into this new technology field with green label. And also, if you have read through last 1.5 to 2 years, there is a barrage of articles and the wish of the government of India to use more and more green technology in the agricultural field. So we thought that it would be we found it a very opportune time to get into this greenfield business and see what can be done with this technology, which with this company, especially they have the expertise in. Our R&D does not do this kind of R&D, or even our parent company would do R&D in a large manner with the existing chemistry or the chemical products. And even if you see SEC is buying green technology companies around the globe, I think it is even their priority. So even though it is a very small company, let me tell you that the interest from the parent company was so high that people from every corner of the globe had come down to India to visit this company, to see this R&D, what they are doing, and everybody were astonished to see the type of work this company is doing. So we find in future this will be a very, very appropriate acquisition.
And just to add to Mr. Shah, I think so this is a very, very niche kind of a R&D and the technology which we have got access to through this acquisition, which we did not have in-house. And some of these technologies are very complementary to our existing businesses. And we believe that the technology is world-class. It has a lot of, I think, potential both in India and globally. And as Mr. Shah mentioned, I think this is very much in line with the integrated pest management and integrated plant nutrition management proposals and initiatives by government in India and across the globe. And we are very, very bullish and confident that this company with its core niche R&D technologies can scale it up very, very fast, the business potential.
Okay. My second question is that in a conference call, like I think a year or year and a half back, we had spoken about being in conversation with our parent company to bring, say, the IT chemicals, the pharmaceuticals, and these other business divisions into India. So I just wanted to check if there's any progress or update on that front.
The talks are on. this year, I think everybody, including the parent company or the associate companies across the world, and including us, we are sort of bogged down to look at our own house first, rather than have a very, very forceful push for these new initiatives. They have not stopped. The talks have not stopped, but I think we'll take it up once we have got the merits and of completing this year.
Okay. So in the last few quarters, like since the last 1 or 2 years, actually I've noticed this animal nutrition and environment health business has not really grown very much. So I just wanted to understand, like, where do we see this heading in terms of revenue and profit potential?
So I think animal nutrition is a very, very good business for us in a sense. And of course the pricing, if you see, you are seeing the value drop or not increasing that much. But during the year, as compared to the previous year, the prices of this product have gone down by 38%. And we have maintained almost a similar kind of volume because we have increased the volume by almost 31%. So the price reduction impact is not seen that much. But the fact that we have increased the volume by 31% during this current year in this first 6 months is speaking of the the goodness of the product for the industry which they are using in. And I think the overall we feel that the eggs consumption and the chicken consumption and all that is likely to go up as the price income or the income levels keep on increasing, and it's a very, very uninterrupted business for us, and we are confident that we'll keep on increasing the volume of this product. ESD, you have rightly observed, it has gone down this year. This was basically again due to the stock levels of the products at our B2B customers like Godrej or Johnson & Johnson or Beckaiser. I mean, everybody has a lot of stocks, and we have not been able to sell as much as the volumes as was given to us by them in the beginning of the year. However, I think the situation is slightly improving. We are going to see, we have the plans from the month of November till March. I think we will be in a position to revamp the sales of this ESD products. Again, this is also an important sector for us. We are also going to launch 1 or 2 new products in this ESD business, and it is looking good for the future.
Okay, thank you so much.
Thank you.
Thank you. The next question is from the line of Ananda Padmanabhan from PGIM India. Mr. Padmanabhan has dropped from the question queue, so we'll take the next question from the line of Prashant Biyani from Elara Securities. Please go ahead.
Yeah, thank you for the opportunity. Sir, how are you seeing the demand environment globally from your affiliate companies and also from third party for second half?
If I talk about the indications, they are extremely good for the second half. However, I am sitting in Indian market, so really speaking, I don't know what is the market conditions over there. It can change. I think the indications are very, very positive for the second half. But what really will transpire into actual business, we'll take it up month by month. We are prepared for the production. We have procured the raw materials or contracted the raw materials at very competitive prices, and we stand equal chance to get this business with Chinese competition for the second half. I think things are slightly looking better from the perspective of global markets as compared to the first half.
Right. Sir, on the expenses side, I think we had initiated cost reduction exercise somewhere around Q4. Q4 and Q1 were fine, but this quarter again, other expenses has gone up on an absolute amount as well as a percent of sales, despite good decline in sales. Is there anything one-off, or if you can explain on your cost reduction efforts, why it has not reflected in other expenses?
I think the cost reduction is definitely on, and we have achieved also cost reduction. We had, ERE cost always, I think in our case also it has gone up by 7% or so. However, the major cost which went up during this year was due to, drastic revision of wages by the Gujarat state government. I think the increase was almost 25% of as compared to the previous year. And this was across the state of Gujarat. And we have 4 plants in Gujarat, only 1 plant in Maharashtra. So the cost of wages went up drastically during this year. Now this is, you may call it one-off in the first year, but it will continue to be there forever. And if you see, I think we have reduced, apart from ERE cost, we have reduced the cost by almost 15 crores rupees in the first half of other fixed expenses. So our attempt to reduce the cost is absolute and very, very serious. I mean, even the marketing cost or marketing efforts, marketing cost has been reduced. Out of this 15 crores, 4.5 to 5 crores rupees is only reduction in marketing cost. So traveling or such things, all the areas we have covered in cost reduction.
So the wage cost would come ideally in employee cost, or it shouldn't reflect in other expenses, if I am not wrong.
No, so other expenses have gone down by 15 crores. And if I leave alone the ERE cost, which includes all salaries and wages, then it would be, the other costs have been reduced.
And
our request is to always look at the performance over longer period. Like if you look at the 6 months number, then they look more clear and accurate. Quarter to quarter, sometimes there is variation of 1 or 2% in the other costs because of the provisioning and a lot of other factors which we have seen. But as Mr. Shah mentioned, there are very conscious efforts since beginning of the year, and we feel that I think the same kind of trend continues because we are still not back to the normal level of business at this point of time. So our cost reduction efforts continue for this full year.
Sure. Sir, on this Barrix acquisition, if you can elaborate on the plan to take the company's product global, because while the technology is not that new, the acceptance in the Indian market is also not that much. So on the global demand side, how do you plan to cash in on the same and by when?
So Prashant, I think globally this is a very large and a growing business. And the pheromone segment, which we talk about, the niche technology. So in the global market, we believe that the overall potential is very, very large. However, the regulatory challenges, because these products in some of the global markets need registration. So we have started talks and discussions internally that how we will be taking the products globally. And we believe that some of the products which are not requiring registration can be capitalized very, very quickly. And the other products which may require registration in some other geographies may take a little longer period. So we believe that in next 2 to 3 years we should start seeing a lot of movement in that, and the same kind of movement can continue in the longer period of time. And however, exports growth will not be like so immediate that it can just start in next quarter or 6 months or so. It is going to take some time. As I mentioned, that we have to secure the regulatory approvals and also the suitability of the product in each market, the testing, the trials, sort of those things are required. While some bit of that work has been done, but we will be accelerating that investment into that front. If we talk about the Indian domestic market, we believe that company has a very small market share today in this particular segment, and this market particularly is growing very large. And as per our estimates, whatever we have calculated internally, this is approximately 400 to 500 crore market today, which is spread across several unorganized players. And there is no single large player who is having a very good national level presence, having very good technology. With the technology this company has access to and a lot of good work they have done, they have the potential to take a leadership position into this particular segment, and that segment is also expected to grow to say double or triple in next 4 to 5 years as per our estimates. So we believe that company is at a right point of time. The size might be smaller at this point of time, but company has ability both from technology point of view, from market point of view, in Indian market and global market, to grow at a much faster pace. And that is what our belief is, and that is what the rationale for this acquisition is.
Yeah, just to add, as Shashan mentioned earlier, this is a technology where we do not have presence now. The green technology, and if you look at mid-term, long-term, this is going to be a nice complementary portfolio for our existing chemical portfolio, and that's the whole purpose of this acquisition. Not only for domestic market, for the international markets as well. It's more, we look at it as a complementary portfolio to our existing portfolio and to put resources to ramp up their business.
Sure. So what would be your capex plan for next year?
So, Prashant, right now, I think we would stick to the normalized capex, which we say about 15% of EBITDA. Any incremental and additional capex for any specific projects will be announced as and when we approve. But as Mr. Shah mentioned, in the current times, I think the most important factor is to see the right growth and get back to the normalized level of business. And talks on the further projects to be approved are on. So R&D teams from India side, the projects team, they all are doing calculation. We already have the land available. All the initial approval for the land and the new site at Dahej are under process. So hopefully in 2024 we can get the approvals from the government side in terms of environment, and then our board will consider various projects in discussion with our parent company SEC. So as and when more and more projects are approved, we will announce further capex. But at this point of time, 15% of EBITDA, and the applications and all these things for the initial approvals for that site in terms of the environmental clearances and all other basic approvals is already in the process. So once, depending upon the approvals from the government and also depending upon approval from our board and parent company on various specific projects, we will announce the capex for the next year.
Sure. Just lastly, one data-related question. This specialty and generic business mix that we share in PPT is relating to domestic brand business or full domestic business, or if you can clarify that?
It's the total ASD business.
Which is
the total business of the company. In total company level.
Total sales, including export, domestic, all.
Yeah. And including the animal nutrition and ASD business.
Right. Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Ananda Padmanabhan from PGIM India Asset Management Company Limited. Please go ahead.
Thank you for taking my question. Hope I'm audible. So for the first half, your domestic revenues have declined by around 15%. So how much of this would have been because of glyphosate? And if you could just give some color on in terms of volume or value growth, or how much has been because of the fall in realization, and how much would have been the volume growth for on H1 basis?
So I think Mr. Shah covered this point briefly. Approximately 15% degrowth in the business in first half. Approximately overall, say 3% could be attributed to the price, and approximately 12% could be due to the volumes. And if we look at the overall glyphosate business, I think while prices have suffered 25-30% kind of a reduction, but our volumes grew by approximately 5%. So while there is an impact, but basically to some extent we can call that the last year's extraordinary prices have corrected. The prices still continue to be higher as compared to the last 5 years average, and we continue to be, I think, having good, situation in glyphosate and all several molecules in terms of the current cost, current selling prices, the margins level. And but as compared to last year, which was extraordinary profitable, extraordinary high price levels, we are down as compared to that.
Okay. And so on a H1 basis, the kind of fall in gross margin that we are seeing, is it fully attributable to the glyphosate or even except glyphosate, or is there any other moving parts to the overall gross margin fall that we are looking at?
To a large extent, this attributes to the high cost inventory which you were carrying at the beginning of the year. And in Q1, if you see, the gross margins were very, very adversely hit. In the Q2, we have improved the gross margin. The overall gross margin reduction is not very, very high. It's between 1 to 2% overall, if you look at the full H1. And also, I think what we believe is, see, even in the COGS, which is your total cost of raw material, there are always fixed costs. So what we believe is in terms of the parity between the raw material and the intermediate purchase prices versus selling prices, overall we are at par now as compared to the historical levels. But the fixed overhead going up with the inflation rate and the lower level of sales, all of that has also contributed to the increase in the COGS and the fall in the gross margin level by 1 or 2% overall on a first half basis. So we are, I think, that way we are a little bit in a better situation as compared to Q1 in Q2.
And to add, it is not only glyphosate which has contributed to this. I mean, all the products, like if you see generic products like chlorpyrifos where our volumes are high, profenofos where our volumes are high, also some adverse effect on our one plant which manufactures quinalphos and ketoconazole was non-operative from the month of April to almost August end. And really speaking, there was no production, and we had to spend extra amount of money to get our requirements from outside on a job work basis or anything. So that cost also has increased substantially. So in the first half, as I said, there were many factors that attributed, and all these products, raw materials, which we were carrying, chlorpyrifos or profenofos or anything, that also impacted because the selling prices or the prices of these products came down drastically in the marketplace, and we had to consume a high cost inventory. But as I mentioned earlier, thankfully we have now, since the end of July and beginning of August, we have no such high cost inventory, and we are back to our normal margins.
And the second query was regard to the upcoming Rabi season. So while you have mentioned in the call that you have substantially reduced your working capital and the inventory, but if I look from a channel inventory perspective in the market, we are entering into Rabi season. How do you see the on-ground situation with regard to inventory with the dealers and distributors?
See, more than the channel inventory, there's a concern in terms of cropping condition. If you look at all the data indicates that, the reservoirs are just about 70%, and there is a question of second crop coming in few places. If, for example, the second monsoon goes well, especially in South India, if the crop acreage comes, especially paddy, and the irrigation is water available for key crops, I think demand will pick up. At least for our products, we don't see much of a channel inventory because, we were selling, we did not sell aggressively in the first half of the year, or more so in the second quarter. So our products are not there. It should pick up. Demand should pick up if the cropping area comes to normalcy.
Okay. And how should we look at exports? Exports had seen a very sharp decline in the first half, close to more than 50% decline if I just compute the numbers. So what are the key drivers for this decline in exports, and how should we look at going forward?
Yeah, it's a combination of factors. One is obviously the LATAM demand, where we export quite a bit of our products. The price has come down for, like products like chlorpyrifos, ketoconazole, for all these products, prices have come down. So combination of both volume decline as well as price decline. There is no demand LATAM. As an industry, all the companies are going through that. Now the indications are positive, like Shashank mentioned a few minutes back. The indications are positive. Of course, we need to wait and watch how this is all going to translate into sales in the coming few weeks and few months.
How much would have been the volume decline in H1?
Let me add, this actually in any country, including LATAM, there is no issue on the product demand. So it is not that they are not selling the products. The only correction is inventory levels, high cost inventory levels which has to be disposed of. All this has forced the global companies into controlling their inventories to such a large extent. And it is not only LATAM or anything. I mean, I'll give you a recent example. We sell a huge quantity of profenophos to Syngenta for global market. And what we were told that there is a full stop to not increasing 1 kilo of inventory till 31st December, which is their year ending. So they postponed the entire purchase from November, December to January, February. So it is across the board, across the countries, that the inventory control of the companies have become so stringent that there is no scope of selling any extra quantity to any of these companies. And unless their own inventory levels are disposed of, they face two challenges. One is to dispose of the inventory, and another is to dispose of the high cost inventory. So all the companies are taking a lot of losses in taking out the high cost inventory and liquidating it. And that is why the first half you are seeing such a drop. I mean, it was a shock to us as well. But learning as to what are the reasons behind this, I mean, we are okay. I mean, it's a postponement, or the normalcy will be there in coming months.
Okay.
As I said, there is no problem of demand of products in any of the market.
Okay. But if you look at the recent commentary or guidance downgrade by a couple of these global agrochemical majors, it appears that at least even in the near term, the situation does not seem to be abating. So should we take, at least for the next 1 or 2 quarters, we should take this as the normalized run rate before we see a sharp recovery in FY25?
So, sir, we will not be able to comment very specifically.
No. I would say that cautiously, if one wants to approach this subject, I think up to Q4, we may see a better, prospect than the Q1 and Q2. But a real normalcy should come by the first quarter of 24-25.
Okay. And export also, would glyphosate have played a role, or in the overall scheme of things, glyphosate was not such a big...
No, glyphosate is a second half export for us, which we feel it will still happen.
Okay, fair enough.
We don't export any glyphosate in H1.
And even from H2 point of view, from export point of view, glyphosate is not a very, very big molecule for us.
Okay. And what would have been the volume decline in exports for this year, if you could share that number for H1?
Roughly, as you rightly mentioned, the total decline in exports is approximately 45-50%, and roughly equal amount, I think about 30% volumes and 30% in pricing.
Okay. The pricing impact has been much more severe in export vis-a-vis domestic.
Pricing could be about 20-25%, but the volume impact is higher than the pricing impact overall.
Okay. Thank you. That's all from my end.
Thank you so much. The next question is from the line of Bhavya Gandhi from Dalal & Broacha Stock Broking. Please go ahead.